Welcome back to the deep dive. We're digging into the Q3 2025 earnings call from Las Vegas Sands, ticker LVS. It dropped after the bell, and let's just say the market noticed.
Oh, definitely. This wasn't just a beat, it felt like a statement. Management sounded incredibly confident, and frankly, the numbers backed it up. A really strong signal, especially from their Asia operations.
Okay, let's get straight to those numbers then, the ones that jumped out immediately. Adjusted earnings per share.
Yeah, the consensus was looking for, what, 60 cents? So, I mean, that's an 18-cent beat. Pretty substantial.
Huge beat. And revenue.
Also strong. Came in at $3.33 billion. That easily cleared the $3.3 billion expectation. Represents about 24% growth year over year.
Solid growth, but the real story often is the property level cash flow, right?
Mm-hmm.
The EBITDA.
Exactly. And consolidated adjusted property EBITDA was massive, $1.34 billion. That really tells you how well the core assets are performing, especially in Asia.
Right, because that $1.34 billion, a huge chunk of that is coming from just one place, Marina Bay Sands in Singapore, MBS.
MBS was just on another level this quarter. It pulled in $743 million in adjusted property EBITDA. And get this, the margin was 51.7%, almost 52 cents on every dollar dropping to the bottom line there.
That's incredible. And didn't they basically have to walk back their own previous guidance during the call?
They did, yeah. Pretty much admitted their earlier forecast for MBS, around $2.5 billion annual EBITDA, was just too cautious. The CEO basically said, look, we're already tracking way over $2.1 billion year to date, with Q4 still to go.
So the new expectation is much higher.
Much higher. They're signaling it could land somewhere between $2.7 billion and maybe even $2.9 billion for the full year. That's a huge upward revision.
Wow. Okay, so when you see a jump like that, you have to ask why, right? What changed fundamentally?
And that's where it gets really interesting. The aha moment on the call, I think, was around baccarat. Specifically the hold percentage and the tech they're using.
The smart tables. I remember hearing about those. They allow for a new way to calculate the theoretical hold.
Precisely. But here's the key thing. The tables themselves are just, let's call them very accurate scorekeepers. They give LVS incredibly detailed real-time data on how people are betting.
Okay, so what did the data show?
It showed a really significant shift in player behavior. More and more players across the board, it seems, are making side bets and proposition bets when they play baccarat, not just betting on player or banker.
And those side bets, they have a higher house edge, right?
Much higher. Think about traditional baccarat player banker bets. The house edge is pretty thin, historically around, say, 2.85% theoretical hold. It's often seen more as a game to keep high rollers happy than a huge profit driver itself.
But these side bets are different, like betting on pairs or specific outcomes.
Exactly. Those bets offer bigger potential payouts, maybe 10 to 1, 20 to 1, whatever it is, but the odds of hitting them are much lower. So the mathematical advantage for the house, the theoretical edge, is way higher on those bets compared to the main game.
So the smart tables just confirmed that enough people are making these higher margin bets now to actually lift the overall hold for baccarat.
That's the story. The data confirmed player preference has shifted enough that the effective theoretical hold on baccarat at MBS is now tracking consistently above 4%. That's a fundamental change in the economics of one of their most important table games. It's not just luck or volatility. It seems structural.
Okay, a jump from roughly 2.85% to over 4%, that is huge. So naturally, are they taking this show on the road to Macau?
Absolutely. They confirmed it. They're rolling out the smart table tech across their Macau properties. It's already done for the non-rolling tables, and they said the rolling segment is nearly complete.
And the expectation is the same dynamic will play out there. Players will go for the side bets.
That's the bet they're making. That player behavior, that propensity for the higher margin wagers will translate to Macau and boost hold rates there too. It could significantly improve the profit profile in that market as well.
Interesting. Let's pivot to Macau then, because even with Singapore shining so bright, Macau is still the bigger market overall, right? How did it perform?
Macau's adjusted property EBITDA was $601 million. Now, they did flag a negative impact, about $20 million, from a typhoon during the quarter, so keep that in mind.
Right, and the margin there.
After you adjust for some high hold variance, the underlying margin was around 31.5%. Still very healthy, but you can see how it highlights Singapore's, exceptional profitability.
And what was the management commentary around Macau? I heard they were pretty frank about maybe underperforming a bit historically.
They were quite candid, actually. They acknowledged they hadn't performed as well as they perhaps should have in recent years. They realized just relying on having great buildings wasn't enough. That led to a conscious shift in their marketing strategy starting back in Q2.
Okay, and is that shift paying off yet?
Looks like it, at least initially. They pointed to an immediate pickup in their mass market revenue share. It went from 23.6% in the first quarter up to 25.4% in this quarter, Q3.
So a gain of almost 2 percentage points, is that sustainable, do you think? Or just a temporary bump from spending more on marketing?
That's the million-dollar question, isn't it? Management obviously believes it's the start of a trend. They're really focused on holding on to those gains. A lot of that focus is on the Londoner, specifically getting all the Londoner Grand Premium rooms and suites fully operational.
Because the Londoner is key to their growth plans there.
Yeah, they've pegged the Londoner as their next billion-dollar EBITDA property. So seeing market share gains now as that property ramps up is definitely encouraging for them. But like you said, we probably need another quarter or two of data to really see if that 25% plus share holds steady.
Okay, so huge cash flow from Singapore, driven by this gaming innovation, and Macau showing signs of a positive turn after a strategy shift. That brings us to the balance sheet and what they're doing with all this cash.
Right. The balance sheet looks very strong. They ended the quarter with $3.35 billion in cash on hand. Plus, they have another $4.46 billion available through their credit facilities. That's lots of financial flexibility.
And a big chunk of that future spending is already earmarked for Singapore, right?
A very big chunk. They've got that $4.89 billion delayed draw loan specifically for the massive Marina Bay Sands expansion, the IR2 project. We're talking an $8 billion total investment there.
$8 billion. That's a huge bet. What's going into that?
It's not just more hotel rooms or casino space. A key piece is a brand new state-of-the-art 15,000-seat arena or performance venue. Putting that kind of capital down, $8 billion, it just screams long-term confidence in Singapore tourism and their ability to draw crowds. It's built on the success they're seeing right now.
And beyond investing in growth, what about returning cash to shareholders? Were they active there?
Extremely active. They bought back $500 million worth of their own stock just in Q3. And maybe more importantly, the board gave them a lot more firepower. They upped the total buyback authorization to $2 billion and extended the time frame out to November 2027.
$2 billion in buybacks authorized and the dividend.
That was another big signal. They announced a 20% increase to the annual dividend for 2026. It's going to $20.20 per share for the year, which works out to $30 per quarter.
Okay, so think about this. They see these amazing Q3 results, this potentially structural uplift in Singapore's profitability, and then they commit to a $2 billion buyback and a 20% dividend hike.
Exactly. Management wouldn't make those kinds of capital return commitments unless they felt extremely confident that this higher level of cash flow, that $2.7 to $2.9 billion annual run rate from MBS they're now guiding to, is sustainable. It's like they're telling the market, this is the new floor, folks.
Makes sense. Just a couple of other quick strategic points they mentioned.
Yeah, two things. One, they increased their ownership stake in their subsidiary, Sands China, up to 74.76%. That's basically the maximum allowed, so it really tightens the connection to all the cash generated in Macau. And two, they confirmed they're shutting down their online digital gaming efforts. They basically said it wasn't a good use of capital, and they're doubling down on their core business, the big physical high-margin resorts. Focus.
Got it. Focus on the core. Okay, that brings us to our final segment. And let's be crystal clear. This is not financial advice. Absolutely not. We're just looking at the information from the call and sketching out a, let's say, provocative but maybe plausible trade idea based on what we heard.
Definitely not advice, just an exercise in connecting the dots from the call. The whole idea really pivots on that standout performance in Singapore and the clear confidence management showed with those capital return decisions.
So what's the outrageous but plausible trade idea?
Okay, here it is. Long LVS. Short a competitor that is much more heavily focused only on Macau. Let's call them XYZ Macau Pure Play.
Right. So betting on LVS, but hedging out some of the pure Macau market risk. What's the thinking behind that?
The rationale comes straight from the call. LVS management basically just told the market, maybe implicitly, that this near $3 billion annual EBITDA run rate for MBS isn't just a one-off good quarter. It's the new baseline. The fact they committed to that huge buyback and dividend hike after seeing these numbers suggests they believe that cash flow is durable even before the $8 billion expansion adds more capacity down the road.
So the trade bets on Singapore being structurally better now.
Pretty much. You're isolating the LVS story, particularly the superior high-margin Singapore asset which operates in a duopoly, as the key driver. You're betting on the power of that redesigned Singapore gaming experience, fueled by those high-margin side bets to keep compounding cash, arguably more reliably than a company facing fiercer competition in Macau alone. It hedges some geopolitical risk too.
Okay, interesting way to frame it based on the call data. So wrapping this up, what are the main things listeners should take away from this LVS deep dive?
I'd say three key things. First, the sheer size of the earnings and revenue beats, they just blew past expectations. Second, the strategic pivot in Macau seems to be bearing early fruit with those market share gains. And third, maybe most importantly, the profound impact that gaming innovation, specifically driving players towards those higher margin side bets via smart table data, is having on the fundamental profitability of Marina Bay Sands.
It really feels like that Singapore story, driven by the side bets, is the core narrative shift here.
I think so. And it leads to the final thought we want to leave you with. Consider LVS management's track record. They've often been conservative in forecasting MBS's potential. Now, on this call, they referred to the current performance, this $2.7 to $2.9 billion run rate, as just the initial stages of realizing the property's full potential.
Initial stages, wow.
Yeah. So the provocative question is, if this is just the beginning, what does the actual ceiling look like? Especially once that massive $8 billion IR2 expansion eventually comes online and they potentially replicate some of that side bet success across Macau. They might have just shown everyone a pathway to a structurally higher margin future than maybe the market was anticipating. Something to think about.